Hello everyone. Can you hear me? Can you see me? Let's check everything to be sure. I think there is some small echo right here. All right. So, guys, once again, let's make a sound check, video check. Type plus in the chat if everything sounds clear, if you can see me well, if the image is crispy, it's not lagging, everything is good. Type plus in the chat. If something is wrong, type what is wrong, and we'll fix it during the next couple of minutes. But I hope everything will be fine. Right. Welcome. Hello everyone. Welcome. Really glad to see you all here. I mean, to chat with you here, of course. Hello. Yeah. Great. Thank you for the compliment. Yeah. Okay, I see a couple of pluses. I hope everything is good, but I have the chat over here, so if everything happens, just type in the chat. I will be checking it from time to time to talk with you guys, to communicate, to get acquainted, to know each other. So this will be a great time. I don't want to like spoil your evening. I want to stress you out here. I want to educate you. I want to speak with you, to know you guys, and to just have some amazing time together. And during the next hour or hour and a half, we will learn a lot of new stuff. We'll go through a lot of different concepts from ICT or smart money concepts. We'll like be fascinated. I hope you'll be fascinated with what you see. Just, I think, a couple of minutes of waiting time for everyone to get ready, for more people to come in, and we can begin. All right, and while we are waiting for more people to come in, let's chat a little bit. I know you guys, if you have been to at least, I think, one webinar, you have got questions like what is your favorite trending instrument, or where are you from, or some questions like this. But I want to know you in more professional terms. You are traders, I'm traders, so let's chat in a different way. Leave a plus in the chat if you ever felt like the market was reading your mind in the worst possible way. Leave a plus if the market just went against you as soon as you opened the trade and went to take profit as soon as you closed the trade with losses. Also, don't stop here. Leave a plus if you ever thought just one more trade and then you instantly regretted it. One trade that ruined all your trading routine of the day or maybe of the week. I had such situations in the past, so I want to know how many of you guys had the same. And finally, leave a plus if you often change the way you look on charts. Maybe you're a skilled trader with years of experience, or maybe you just began trading, but still I think most of you guys change the way you look on the charts, on financial markets from time to time. We adjust our strategies, we include something new, we discard something that we think no longer works. And leave a plus if you do this often, in your opinion, maybe every month, every several months, or maybe every couple days. It will be interesting. Yeah, I see some pluses in the chat already. That's great. That means that we have something to talk about today. Yeah, not the owner, but a great guy. That's the greatest words that I have seen today. Thank you. Of course, we have instant funding support here with us in the chat, so feel free to ask some technical questions or just whatever you want to ask. Either the support team or me will try to answer these questions. All right. I think that we can slowly and steadily start our webinar. This is the ICT Inner Circle Trader, or smart money concepts. You can call it whatever you like, whatever you want. Probably you have heard several different names of this trading approach here. And during the next hour or maybe more, I will tell you everything you need to know to get acquainted with the smart money concepts, to get deeper into it, to understand the logic behind this concept, behind this trading approach, and maybe to incorporate it into your trading. To start with, of course, I need to tell at least a couple of words about myself. My name is Edward. I have 6 years of trading experience, 3 years of educating others, and I think more than 100 articles on investing, Bloomberg, CoinGecko, Forex Street, Forex Empire, and all other websites that you probably have at least once visited. I don't want to brag too much, because if you're already here, then probably you know why you are here. You want to learn more about smart money, and I practice smart money concepts for more than several years now, so I think that I know what I'm talking about. At least I hope so. And to start with, I want to first talk about what smart money is and what smart money isn't. A lot of people on the internet, probably some people from Instagram, can tell you that smart money is a one-stop shop for everything. That this tool can predict the market, that this tool can tell you where is the big capital is on the chart and how to act in each and every situation. And like, smart money is some holy grail of trading. Unfortunately, or maybe fortunately for us, that's not true. That's not even close to the truth. Smart money, of course, it cannot predict market. Otherwise, like, why would I be here if I can predict market with 100% accuracy? Probably I will be somewhere on Wall Street, or maybe flying in space, I don't know, fulfilling every dream that every person could have. But smart money cannot predict market like that. Smart money also cannot save you from gambling. If you're a gambling person, if you don't want to work with the risks, if you don't want to get better in trading, smart money can save you from that, of course. And finally, smart money isn't some static system that you need to learn one time and then use for the rest of your life. Smart money is changing, and ICT, smart money, I will call it different ways just to not get the same word every time. Smart money have changed even through my experience and through experience of hundreds of traders who I know. They started with some concepts, and then these concepts and these approaches evolved to something different. This is not a complete change of the strategy. Nevertheless, it's a change. It's an evolution of the concept and of the approach. And what smart money is, for my opinion, and I think that's pretty close to the truth, that smart money is a set of concepts for chart analysis. It's an approach for understanding price movements. You can call it an attempt to understand the price and to find an institutional trader and follow it. I will talk a lot about this certain string of text here, so keep connected to the webinar. It will be very interesting, I promise you. Also, I think that smart money is a way, and a very efficient way, of creating an order in your trading. And finally, I hope that smart money is something that you will use after this webinar, and you will use it a lot. Maybe some parts of it, maybe all parts of it, but smart money will get into real life, and there is nothing, I think, we all can do with that. During this webinar, I will tell you how to understand the trend like never before, probably. I will explain why the price moves like it moves. What is the logic behind most of the moves on the chart. Also, we'll talk about where to enter and exit the trade. Of course, trade execution are a big part of trading. I will tell you how to win when losing. Probably you can guess that this part will be about risk management, and some tips on how to make your strategy better, and how to make your strategy better even if you dislike the smart money concepts, even if you choose to stick with fundamental technical analysis, I don't know, moon cycles. I will explain how to make every strategy better. So keep connected, and of course there will be some special offers during this webinar. Are you ready, guys? Type plus in the chat if everything is clear, if you're ready to get new knowledge, and if you're comfortable with the new knowledge that you will get during this webinar. I'll drink a sip of water and we'll start. Right. Great. I see some pluses already. Let's go. Have fun. Type anything you want in the chat. Let's talk with each other. It will be a great webinar, I'm sure. All right, the first thing first. I want to tell you about market structure. Maybe you already know how market works. Maybe you know that there are uptrends and downtrends on the market. The price moves in different directions. Sometimes it moves right, but it never moves left. But I want you to look at market structure from a little bit different perspective. As for me and in smart money, market moves in 4 different phases. The first phase is impulse. Then comes correction, reversal, and sometimes consolidation. On a scheme like that, it looks as following. Impulse is a fast and relatively small in time movement. It is pretty big compared to correction, which is usually smaller, takes longer time, and goes against the trend. So 2 things here. Impulse is a trend movement, and correction is a counter-trend movement that is slower than the initial impulse. The reversal is here just to understand that the price sometimes reverses. Even in impulses and corrections, reversal happens, and after reversal, we usually expect another impulse in the direction of the trend. From time to time, on every market, a consolidation happens. You know about consolidations, it's just a sideways movement without any significant new highs or lows. The price just stays in this square manner, I would say. But on the scheme, it all looks perfect, of course. We need to look on the real chart, and on the real chart, things can look a little different. First, we have this impulse. It looks great. It is a fast movement. It is small in time. We have these long candles with small wicks. Everything looks great. Then a correction happens. The correction movement is smaller. Smaller in terms of price movement than the initial impulse, but it takes longer in time. Everything seems good till now. After that, a reversal happens. Usually we need to look for reversals on a smaller time frames. I'll talk about that later, but reversal is where the price obviously continues to move in the initial direction, in the direction of the main trend. After that, another impulse happens. This one is way longer, and very small correction happens. I'll talk about why this is still a correction in the next slide. Then another reversal and another impulse. And in the end of this slide, we have a consolidation. Seems pretty good for now. The market has 4 phases, and every phase has their differences, so we can separate one from another. But how to understand the market structure? How to understand that this is an impulse, this is a correction, a reversal, and a sideways movement? To do that, we need to go on the real chart. On the real chart, we can start by analyzing anything we want. But the main thing, I think the first thing that you need to analyze on a new chart is the trend direction. And it's simple. The price moves up, it's an uptrend. The price moves down, it's a downtrend. But how to formalize it? How to make these rules more strict? To separate the uptrend from a downtrend with 100% accuracy, no less than 100% accuracy. To do that, we need to mark higher highs, higher lows, lower highs, and lower lows on the chart. And here we can see the price was moving downwards, then the trend have changed. The price started moving upwards. Here, this high goes above this high. Oh, this is too big. All right, goes above this high. Now we can say that the price is an uptrend, and this is an impulse. This here is a reversal movement, and this movement here is an impulse. This is a correction, and this is another impulse. Now we are in an uptrend. The price forms new highs, and these highs are above the previous one, and new lows are also above the previous lows. To show it to you, let me just put it here. All right, yeah. This is the trend direction, obviously. The price went down, then the trend have changed, and the price started moving up. But let's look a little closer to these higher highs, higher lows. What do they consist of? What is inside these points that are not just highs? How to understand that this is a high, especially when we don't see the rest of the chart? Here is the finished picture. We can see what happened after. We understand that the trend have changed because we here know the future. But in real time, how to understand that this is really another high or another low? To do that, we need to learn what is swing high and swing low is. So, listen carefully here. Swing high is candle, and left and right candle out of this candle is lower. It's opened lower than the swing high and closed lower than the swing high. And the swing low is the exact opposite. It's the middle candle and left and right candle out of this middle candle opened and closed above the middle candle, like this. We can see that there is a middle candle and both candles opened and closed above it. The same here. We can see a middle candle and rightmost and leftmost candles opened and closed below it. The same here. Oh, here, yeah, and here. So, what happens when price breaks above the previous high or breaks above the previous low? What would happen if the price broke through this line here? What would happen? How would we call it? And what would it mean for the price? We would call it the break of structure. This is probably the first pure smart money term that you will hear, not the last definitely, but it's very important. It's one of the most important concepts in smart money. It's break of structure. It's when the price goes above the previous high or below the previous low. Here, the price went below the previous swing low. It's a break of structure in bearish directions, downward break of structure. Here, the price went above, obviously. It's a bullish break of structure. And here. Every time the price goes above or below swing high or swing low, we can call it a break of structure in the direction where the price went. When the price is going down and then we have a bullish break of structure, that means that the trend have changed. And now we are looking for buy trades because we are in an uptrend. And it's just not wise to look for sell trades in an uptrend. The trend tends to continue, tends to persist. You can look on any chart, on any time frame, and you will see that trend is likely to continue. When we have bullish break of structure, it usually just don't stop like it. We usually see more breaks of structure in the same direction, in the direction of the trend. So that's great. Trend is our friend. So when we see a break of structure, we tend to open the trades in the same direction. But you may look at these question marks and ask yourself, and maybe ask me like Edward, I don't understand. I see here way more swing highs and swing lows. I see one here, there, here, like everywhere. It's just everywhere. I see more swing highs and swing lows. I definitely can tell that candles left and right out of the middle candle is lower or higher than the middle one. So this is obviously a swing high, swing low. Why? Shouldn't we call it also higher highs and higher lows? Shouldn't we also make some breaks of structure here? To answer your unasked question, I suggest you looking at this yellow square closer and on a smaller time frame. We are going from 1 hour to 15 minutes time frame. And when we do that, we see a lot of blue circles. But what does they mean? What do they mean? They mean that it is also swing highs and swing lows, but on a lower time frame. This is an internal structure. Here we have a bigger structure. We can call it external structure. The trend is upwards. The price is moving up. But then the price started moving down. Here. On internal structure, the price have been moving down at least half of the chart. Half of this movement is definitely a downtrend. And we can say that here we have a break of structure. In some ways, here we can see a break of structure. It's definitely a change of trend, but on a smaller time frame. It means that what happens on a bigger time frame, swing highs and swing lows and overall trend, it can also happen on a smaller time frame, but in different direction. That concludes us to the thought, to the idea that markets have a fractal nature. And this part, I think, is very important. So listen a little bit more carefully. I know you're attentive listeners, but still a little bit more carefully. The same things that happen on a bigger time frame happen on a smaller time frame. Daily, weekly, 4 hour, 1 hour, 5 minutes, 1 second if you're a little bit crazy. Every chart is the same in terms of breaks of structures, in terms of higher highs, higher lows, swing highs and swing lows, in terms of changes of the trend. And this means that to succeed in this market, we do not need to analyze only one time frame. We need to conduct a top-down analysis. And let me show you instead of explaining it. Top-down analysis is the situation like this. We have a EURUSD chart, a 1 hour EURUSD chart, and the price have broken through the previous high. It is a bullish break of structure, so we need to look for long trades. But where? Where should we enter the market? Should we enter here? Like it's some form of a support line, yeah? Or maybe should we enter here? It is also a support line. Or maybe the price will go even lower and we should enter here. This is still an uptrend. We do not have a bearish break of structure because it would happen if we break through this lower low. Until that, it is an uptrend correction, an uptrend impulse, and a correction out of it. Where should we enter here? To answer that, we need to remember that markets are fractal, and we need to go to a lower time frame, a 15 minutes time frame, and wait for a bullish break of structure here. On 15 minutes time frame, we can see that the price started its correction. We didn't have any break of structure here because it's still an uptrend. It is still a correction of an uptrend on 15 minutes time frame, but we have this break of structure right here. It's a bearish break of structure, after which we have a bullish break of structure. And now we can say that on a 15 minutes time frame, the price have reversed upwards. We now have 1 hour time frame looking upward. It's a bullish trend, and we have a bullish trend on 15 minutes time frame. Two time frames have been synchronized. Now we are twice in an uptrend. It's twice as better. One trend is your friend, two trends are like two your friends. It is way better than looking only at one time frame. Top-down analysis gives you way more information, and that's only the thing where you analyze the trend. You learned nothing else than the trend direction. You learn only one new concept, and now you can analyze a trend like probably never before, like the minority of traders. And to conclude, I want to focus you on some things that you should remember from the break of structure part. First is that market structure tells us the price direction. It is similar to a trend, but it is called differently and it works a little different. Second, break of structure, or BOS, is a trend indicator. When the price moves above the previous high, we have a bullish break of structure. That means that we are looking for long trades, and if the price goes lower, it is a bearish break of structure and we are looking for a sell trades. And third, probably as for me the most important, markets have a fractal nature. It means that what is happening on a bigger time frame can and will eventually happen on a smaller time frame, so it is better to analyze multiple time frames, at least 2 time frames before opening a trade, to confirm your suggestions, to not open the trades against the trend. to be with the trend, to be with the power that moves the market. A sip of water and I'll tell you something amazing. Now, I want to tell you guys about a special offer that Instant Funding gave to me and to you. This exclusive offer can give you 25 savings out of your purchase and increase your profit split by 10%. And of course, it has a limited availability. So take a screenshot. Do not go away from this webinar. Take a screenshot, save it, and return to it later. As far as I know, this is one of the best, if not the best, offer Instant Funding made to anyone. So congratulations to you and me. Needless to say that if you're listening carefully, maybe even making notes, taking screenshots, remembering, thinking about what I said, and apply this knowledge in the future, the increased profit splits would definitely come in handy. You should understand it. This is not a webinar just to listen, it's a webinar to practice after it. So take a screenshot, we'll return to this later. Now, let's return to the webinar itself. Maybe you have some questions. I'll take a sip of water, check through the chat, and we will go to the second topic, which is liquidity. And while I'm asking questions and checking the chat, if there are no questions, type, you will have enough time, type if you know what liquidity is. Share with me your knowledge about liquidity. Have you heard this term before? Leave a plus if yes, minus if no, or say something more than that. Tell me what you know about liquidity. Maybe you never heard it. It's completely great. I will explain everything. So yeah, just check in the chat. What do we have here? Oh, I see a lot of positive comments, guys. That's very encouraging and very motivating. Thank you. Thank you for all these supportive comments. It looks great. All right. So many positive reviews. We are not even like in the middle of the webinar and we have already so much. So you're a great audience, guys. I'm really happy to be here. All right. Yeah. Trade to Profit asked, may I invite my friends here? Of course, the webinar is open. It's available on Instant Funding YouTube. So share it with your friends, relatives, pets, anyone. That's a great thing to share as for me. Right, I see that you agree that the trend is our friend, and about fractal nature, yeah, of course, I see your comments. Great. All right. Okay, I see some comments that you have heard about liquidity, some comments that you didn't hear about liquidity. Great. So what is liquidity? Let's get back. First, what is liquidity in economics? I may start a little bit too far away, but then it will all unravel, uncover, and you will understand what I mean. So this is an important part, guys, no jokes here. In economics, a liquid asset or a liquid anything is an asset that you can buy and sell without problems, without affecting its market price. For example, you have $1 million in your pocket. Firstly, congratulations. Secondly, you can buy millions euro or millions GBP or any other Forex currency without affecting the market. Because Forex is debatably one of the biggest, if not the biggest markets in the world, with trillions of dollars of turnaround daily. That means that even if you have $1 million or maybe $10 million, you can find a place where to place your order without problems, and your order will be executed without affecting the price. The same with indices or big cap stocks. You can buy and sell these stocks on hundreds of thousands of dollars, on millions of dollars, because the trade volume, the daily trade volume, is billions, if not tens billions. The same goes for example Bitcoin, Ethereum, or other huge cap crypto from CoinMarketCap. There are liquid assets that mean that you can buy and sell them easily without affecting the price. with your capital, of course. I'm talking with you, not with some billionaires, but if there are billionaires among us, let me know. And we have non-liquid assets. For example, real estate in some places. In some places on the world, you can easily buy and sell a flat on an apartment, but mostly it's not that easy as buying and selling stocks or forex. You need to look for a great deal, you need to arrange everything. And if you want to sell real estate, sometimes you need to drop the prices in order to find a buyer for your offer, for your sell position. The same with really expensive premium cars or unpopular meme coins or small cap stocks. For example, you can go on some crypto exchange and take $1,000 and open a position with, I don't know, the leverage of 5 maybe, and you will move some small cap stocks, so small cap crypto, sorry. It will really move the price by sometimes by several percent. And this is a $1,000. It is not a big sum of money, like at least for crypto. But to explain what is liquidity in smart money, we need to also understand not what is liquidity in economics, but who are the main market participants. Some of you may think that me, you, and other traders like you and me are the main market participants. That may be true for some cases. Probably you have heard about GameStop stocks soaring several years ago, where retail traders pushed the price. But other than that, you and me and other retail traders are not the main participants. Even if there are millions and billions of us, we do not control the prices. We do not move the market. We do not control the charts. But who controls it? Well, it's obviously those who have billions and maybe trillions of dollars. It's hedge funds, investment funds, pension funds, billionaires, and crypto exchanges for the crypto world, of course. Some players, some huge players that have billions of dollars in their pocket and have the opportunity to control the market. They are the main market participants. And ask yourself, what happens when a huge market participants, for example, on Forex market, for example, some bank, some central bank, wants to buy 10 billion euros for USD? What happens? 10 billion, it's quite a big sum of money. If this bank, this central bank, just presses this big red button with a buy on it, it will enter on the market price and it will get smashed. On this very same second, it will get smashed because there are no liquidity on the market to fulfill these orders. There are no one selling so much euros for US dollars to buy them. And so exactly the picture you can see right now will happen with this bank. It will destroy the chart and it will destroy its order. And a lot of people will get fired in the trading department. And listen to me, what I'm telling, that some bank started buying and destroyed the chart. So like some bank entered on unfavorable prices. You mean that, some bank lost money just by entering the market? Can you believe that? It's just not going to happen. This is not some trader who just entered the market and places buy and sell orders without making any analysis. This is a bank. PhD students work in a bank. Like maybe some geniuses work in a bank. They cannot afford to lose money just by entering a trade. They need to create a market for themselves. In order to fulfill their huge buy order, they need a lot of people willing to sell. Or not willing to sell, but had to sell. Some people just have to sell in some certain situations. And the situation that I will show you right now is one of them. Look at this chart. The price is fairly going somewhere. It's going down right here, it started going up here, but then it suddenly dropped That's too big. Yeah, all right. It suddenly dropped, and then it suddenly started rising without any significant pullbacks, like impulse, impulse, one more impulse, some correction that have been bought instantly, almost instantly. If we suggest that the bank needs to buy a lot of euro for USD, then it needs someone to sell this euro to him. And for that, bank can actually, this is one of smart money concepts, bank can actually affect the price. And bank pushes the price down to collect stop losses of retail traders. Look here with these dotted lines. This is levels where traders usually place their stop losses, because it's what people on the internet teach them to do. You need to place your stop loss below significant support or resistance lines. Here and there and there, and after this significant drop, even there, because the price have dropped, now you can enter a long trade, now you can buy and place your stop loss below the support line, of course. And when millions of traders put their stop losses, they enter long, they buy, and then they put their stop losses. Their stop losses are eventually a market sell orders. When you're buying, your stop loss is a market sell, because that's how stop losses work. So when the price is going down that fast, it triggers all these stop losses, and all these buy trades get closed. And all this selling pressure starts to exist. And now some big banks, some big player have the opportunity, have the ability to fulfill their huge order. Maybe not $10 billion, 10 billion euros, but a fraction of this, a billion. And then it just repeats the process. It creates some levels. Yeah, let me turn on the next slide, yeah, to explain it. Yeah, retail stop losses are here. It creates a lot of levels, and then it breaks through these levels to collect stop losses of retail traders who do not understand how liquidity works, who think that all these levels are just price fluctuations. There are nothing to do with that. There are just some candles. I will put my stop loss below any of these candles, and now we can call it a support line because the price bounced from it. Then this is a support line without any deeper logic than that. Here is a lot of text, but let's read it together and remember how liquidity is created. So the first thing is that market maker, I mean bank, hedge fund, crypto exchange, they draw famous technical analysis patterns on the chart. Then traders who do not know how liquidity works put their stop losses near obvious support and resistance lines. After that, market maker, bank, hedge fund, crypto exchange, they are all market makers, pushes the price to these levels, and when the price breaks through them, stop losses get activated, creating a lot of selling or buying pressure, depending on the trade direction. Market maker, the bank, fills their buy orders with the liquidity created, and then the price reverses. I want you to listen closely to what I'm going to say now. The market is all about liquidity. The slide that you are seeing right now is maybe the most important out of all presentation, or maybe 1 out of 5 the most important slides, because when you understand liquidity, when you understand where stop losses are concentrated, you are defended against them. You can be more powerful than all other retail traders. You can go with the banks, you can go with big players. And if you understand liquidity, you can do not understand any other concept of smart money, any other technical analysis concept, or any other analysis concept. You just need to understand where the stop losses are, who will be the food for banks, and you will have the knowledge that almost nobody has and almost nobody thinks about it. And if you don't understand liquidity, then you will become liquidity. You will become the food for big players if you do not understand how they act and how they work on the market. I hope that this part is pretty clear. But enough of these stressful talks about liquidity, about food for big banks and big players, let's chill out a little bit. Let's play together. Find liquidity on the chart. I marked several numbers from 1 to 5 and type in the chat one number or all 5 numbers or 0 numbers. Where is liquidity on this chart? Maybe liquidity is at the level 1 or 2 or all of them or none of them. So take some time, look at this chart. Now you know how liquidity works. Type any number of numbers to the chat and I'll check it. All right, I see your comments about liquidity. Yeah, that's great. That's great, guys, that you understand this concept. And it's great that you have questions. Of course, questions are amazing. The Socrates, he was great guy. All right. Liquidity means money resting above or below. It doesn't matter. It can be anywhere on the chart. Hedge funds, they trade both long and short positions. So it really doesn't matter. Liquidity is all around. And this is some of a spoiler alert for this question that I've shown to you right now, this game. The answer is everywhere. Liquidity is everywhere on the chart because this is where traders put their stop losses. Traders put their stop losses below significant support lines. Traders put their stop losses above any resistance lines they find suitable. So everywhere is liquidity, and liquidity is everywhere. But thank you for your answer. I see one correct answer, but guys, you just started to learn. Let's look at how liquidity continues to work with the price, how price continues to work with liquidity, of course. So the price have touched only the number 4 from the sell side and number 5 and number 3 from the buy side. Maybe you have a question why? Why the price didn't fall that much? What held the price from dropping below to number 2, maybe number 1? But guys, remember the first part of the webinar, the break of structure part. If we are moving closer, we can see that number 2 is actually a swing low. We cannot see it maybe from this distance, but I assure you this is a swing low. And if the price breaks through the swing low, it means that the trend have changed and now we are in a downtrend. Until then, until the price fluctuates between number 3 and number 4, we're in an uptrend. This is a sideways movement, yeah, but in an uptrend. And when we collect liquidity below the number 4 and above the number 5, yeah, but it's not an important level, but still some stop losses were here, I'm sure. When we collected liquidity below the number 4, the price continues to move in upward direction. The price continues to move with a trend. The trend persists. We do not see a trend change here. Can it go to number 2? Of course. And to number 1, it can go even lower than that. It can go to the beginning of the chart. But this will be a downtrend. And here, as you already know, a trend is your friend. It means that we are looking for buy trades. We are looking for a continuation of an uptrend price movement if we are already in an uptrend. That's great. That's great. I think that we got this covered. Here are several things that you need to remember after this block, after this part. First is that liquidity in smart money means retail stop losses. Liquidity in smart money means your stop losses and mine stop losses. If we understand how liquidity works, we can move along with hedge funds, pension funds, and all the other big players, market makers who have billions of dollars of capital. And liquidity is everywhere on the chart. Every time the price goes above or below some significant level, where it's usually obvious support and resistance levels that everyone can spot, because the more people see this level, the more stop losses will be near this level. So it's everywhere on the chart, but way more liquidity are captured near significant support and resistance lines. And if you learned how to find it, then you're all good. You have increased chances of survival on financial markets and earning. But if you do not know how to find it, if you ignore liquidity, you eventually become liquidity and you become food for big players if you do not know how they act. That's another important part. So, guys, time for your questions if you have them. If not, time for my sip of water. Really excited to tell you all of this stuff. So, if you have any questions, like any questions, even if you think that this is not a very good question, still ask your question. It's just great to have some communication. It's not me educating you without any reverse education. I can also be educated by your questions, because when you ask a really good question, I learn something new about trading. I rethink some parts of trading, and it can really help. All right, so the first question I see in the chat is, which time frame is applicable for liquidity? Every time frame, but the bigger the better. Of course, to collect a lot of stop losses on the chart, you cannot use 1 second time frame, and 1 minute time frame is also pretty chaotic. Why? Because the less time the support and resistance levels are on the chart, the less stop losses are below or above these levels. If you see a daily chart with an obvious support line, you can know for sure, 100% sure, that there are tremendous amount of stop losses near this level. When and if the price breaks through this level, all these stop losses will be activated and some big player will use this. If you're trading Bitcoin, you can check the Bitcoin chart at least in the past and see how the price reacted to significant resistance levels during the Bitcoin downtrend. Every time Bitcoin reached some significant resistance, it fell immediately because someone used this liquidity, these stop losses, to fulfill their selling orders and continue pushing Bitcoin down. Yeah. So every time frame is good, but the bigger the better. Sound is weak. Guys, anyone else have these problems with sound? If yes, tell me. I will make the microphone more responsive. That's not a problem. Just if the sound is bad, tell me. All right. Clear, great. All right. About fundamental, we'll talk about that a little bit later. All right. About current price action or overall crypto market, I do not think that this is a topic of this current webinar, because here we are educating, not like analyzing in real life. But if you have this, if you want this to happen, just write it in the chat. We can do a webinar analyzing any market with smart money concepts. Why not? It's a great practice session. We can do that. All right, sound is good. Thank you. Okay, great. Great, we can continue. You already know that liquidity is the strongest price magnet. Yeah, but anyway, where should you enter the market? Not just break of structure, something bigger than that, something more clever than that. This leads us to the third topic of this webinar, points of interest. There are three main points of interest, or POIs, call them how you like. It's a fair value gap, FVG or imbalance. It's a sell to buy or buy to sell, and it is an order block or OB. Here on this webinar, I want to tell you about sell to buy and buy to sell points of interest, because as for me, they are the easiest one to spot. They are very easy to use. They are also, for me, pretty reliable for Forex market, and I'm a Forex market trader mostly. So we'll talk about as sell to buy and buy to sell. What is sell to buy points of interest? What is sell to buy block? This is the last downtrend movement before a bullish break of structure. To look on this scheme chart, we can see that the price have been moving down for several times, and this is the last downtrend movement before the bullish break of structure. Here the structure have been broken. Now we are in an uptrend. We have these blue circles changed to yellow circles that mean that uptrend have started. This is how it works on my scheme charts. And buy to sell is the exact opposite. It is the last upward movement before a bearish break of structure, before a change of trend in a downward direction. We need to look at the chart to understand. All the scheme charts are pretty easy to understand, but they just don't work how they should. So let's look at the chart that you have already seen. This liquidity chart with a lot of retail stop losses have been collected, and then the price, as you can see, it reversed in upward direction. It have created a bullish break of structure, and then it reversed. Let's see here. Oh, all right. I've marked swing highs and swing lows here on the chart for you to easier understand where the trend have changed, but I think you do not have any problems with that. And this last movement before a trend change is called sell to buy or STB order. So this movement, pretty big, this movement or this movement, I think you understand. After the price have broken the structure, it retests it and continue moving in the direction of a newly created trend. So this is an impulse of an uptrend, this is a correction of an uptrend, and after that another impulse happens. You probably remember it on the chart. Where to enter in this situation? The common rule for STB and BTS, not a K-pop band of course, is to enter on a retest of the point of interest, a retest of the block. So here on the chart, when the price retests the break of structure and we are sure that now the trend have changed, we need to enter long trade, put our stop losses now carefully below the support line, and put our take profit on the closest liquidity possible with our risk management strategy applied. I'll talk about risk management strategies later in this webinar. You probably heard that I've said that you should put your stop loss below the support line. And 10 minutes ago, I was arguing and devastating about putting stop losses below the support lines, because this is what happens when you put your stop losses below support lines. They got liquidated, they got collected, and someone became a food for big player. But now I'm advising you to put your stop loss below the support line? What? Why? But this support line is different. This support line have been created after the price collected money. After the price collected all this liquidity, there are no more liquidity on the chart. And now the price can continue moving upwards. The price have collected all the food. Big players collected all the food. And then the price reversed. So we are now in an uptrend. And we will continue being in an uptrend until the price goes below this support level. If the price goes below it, then the downtrend continues, then we are wrong, but not in analyzing, not in opening a trade. We are just wrong because the market moved against us. There are nothing to do with our mistakes, and this is not a market's fault. It's just how the market works. It's chaotic a lot of time, and we are only trying to understand it. We cannot be 100% sure that we understood the market. We can only define some market logic and try moving with it. That's why I'm telling you to put your stop losses below the support level, because this support level is different from the previous support levels. This support level have already collected some liquidity. There is nothing to do below it, and the price should likely rise. This is the logic. All right. three main components of STB and BTS. Once again, not a K-pop band, but if you're listening to it, no judgment. First component is liquidity sweep. Liquidity sweep is eventually collection of stop losses, of retail stop losses. It's someone becoming food for the big player. Second, it's break of structure or a trend change. And finally, it's retest of the points of interest. Let's look again. We have checked a scenario for an uptrend. Now let's check an opposite scenario for a downtrend. Now it is Euro USD, 15 minutes time frame, intraday trading. We can see that the price have collected liquidity above the previous swing high, and then it broke the structure. It broke the structure right here. Or someone can be more conservative and say that the price have broken the structure right there, here, yeah. That means that now we are in a downtrend. We have collected liquidity, yeah, number one, liquidity sweep, and now we have a break of structure, trend change. Now we need to put our BTS block, turn out any music we want, anything, and we need to enter when the price touches the BTS block, when the price touches the break of structure. Can you enter higher and increase your risk-reward ratio? Of course you can. I'll talk about where to enter the market later, but the general rule that I follow is that I enter on the retest of the block. No higher, no lower, just on the exact same tick where the BTS have been completed, started and completed, yeah. You can enter a little bit higher. It depends on your trading strategy, it depends on your trading approach, but the main rule where the point from which you should start is entering like I advise you to. And then our stop loss should be once again above the significant resistance line, because this is a liquidity sweep. So now this line is really a resistance because the price is just have nothing to do about it. And of course, your take profit should be on the closest liquidity possible. In this scenario is here. What happens after we opened our trade? Of course, it hit take profit. This is an example trade. What have you thought about? I would let it go to stop loss to show you that not all trades are going to a take profit. You know it without me, of course. So this trade is a take profit. Obviously, it's just a great example of a trade I wanted to show you. Sorry for joking maybe too much, but nevertheless, let's chill out a little bit more and play a game with you again. Here are four numbers, 1, 2, 3, and 4. Only one of these numbers are buy to sell or sell to buy points of interest. Tell me what number it is. Tell me in the chat. Because only one of them are this block, yeah, as I said. And as you remember, sell to buy and buy to sell happen after liquidity sweep and after the trend have changed, after break of structure. So what are your suggestions? Let me see your thoughts. Let's discover it together. Maybe I don't know, and you will tell me what is it. I see 2 answers from the same person, 2 and 3. All right, I'll count it as yeah, if one of them is right, then you're right, no problem. I see number 1, I see number 3. All right, great that you have some ideas, that you try to analyze chart with me. That's very nice of you guys. Another 3. All right, time to show the answer. And the answer is actually number 2. Why? Let me show you step by step, and we will start with number 1. All right, number 1 just doesn't collect any liquidity. Like, we have this level where all the stop losses may be located, but this number 1 just don't go above it, so no liquidity sweep. Number 4 is close here, and I didn't show you what happened to the left of the chart, but there is nothing interesting, and for this certain exercise, it's it's none of the importance. Number 4 doesn't collect any liquidity either. It just goes below and then goes above, like lower and higher. It just don't work. Number 3 here indeed collects some liquidity, but we do not have any break of structure near it. We have this correction and then another downtrend movement and then another upward impulse. It just looks weird. We are not in a trend here. It looks like a sideways movement without any significant, without any like powerful ideas of where to enter. And number 2 here is a good example, because we have a liquidity sweep. Even 2 candles collected liquidity, like 2 times is better than 1, and then the price reversed very fast. You can see this impulse, very long candles with a short wicks. The price went down very fast, and we can say for sure, we can be sure that the trend have changed here. So we mark this point of interest as a buy to sell block, and we also mark a break of structure here because the structure have been broken. The price went above the previous high and then fell below it. Of course, we need to put our entry point. Once again, I suggest putting an entry point on the break of structure. Stop loss is above the significant resistance line that collects liquidity, and take profit options are really depend on what you want to see. So we can put our take profit here. This is the most conservative way, and our risk to reward ratio will be 1 to 2 here. But we can also put our take profit here or there. It depends on your risk approach, on your trading strategy, and later you'll understand how to define where to put take profit more precisely. And let's look what happened. Great. Now we have another take profit, another several percents of profit on our account, and also we can see that number 3 also got touched. And this is pretty fresh chart. I made this certain slide like yesterday, so you can see here also that the price haven't reached number 4, but today it have broken through number 4. So this is a fresh trade example. I specifically changed it like days before webinar to get you the freshest idea and freshest analysis possible. Before we go to the next part, which is, I think, concludes everything that you have heard here, I just want you to remember what offer do you have from instant funding. Once again, this is the code on the screen. It saves you 25% and increases your profit split by 10%. It have a limited availability, and this is no simple offer. It's an opportunity to combine a knowledge from the webinar and an improved conditions from instant funding to become better in trading. So don't forget to take a screenshot and to return to this screenshot when you rewind the webinar, if you do that. All right, guys, I'll check the chat and we'll continue while the offer is on the screen. All right, I see an opinion that finding fair value gap is a main in chart structure, and it can be true. You may be right. I'm not against fair value gaps, and I use them in my trading. But if I were to tell you about sell to buy, buy to sell, fair value gaps, order blocks, and some other blocks, it would take not 1.5 hours. It will take several hours, and this is a separate topic, but it's also important. Of course, here I want to give you the essentials, something that you can start with and something that you can later develop and make it even better. But it is good by its own, what I'm giving to you here. So fair value gap is great, but this information is nonetheless amazing. All right, great. Is that BOS on the right of number 3? Let's check. Right on number 3. Yeah, here No, this is not a break of structure because the price, we have this swing high, and this swing high didn't create any new highs, so it's an internal structure. On a lower time frame, probably 15 minutes or 5 minutes, it will be probably a break of structure, maybe. But here, definitely not. This can be a break of structure, but the price moves so slowly, so like very safely, and we can call it a break of structure, but after that another break of structure happens, so we hadn't had an opportunity to look for buy trades. That's how lucky we are, probably. All right, let's move onward to the trades execution part, another important part in this webinar. So trades execution it's not just where to entry, where to exit, but it's also about risk management. And I cannot stress this enough again. Risk management is maybe half of your success, or maybe even more than half of your success. Yeah, I know I've been telling this to you several times during the webinar, but really, the understanding of the trend is a pillar of your trading. You cannot trade without understanding where the trend goes. That's why break of structure is here. And you cannot understand where the price will likely go without understanding liquidity. But it is nothing if your trades are just bad, if you do not have good risk reward and good win rate ratios. And for those of you who do not know what is risk to reward, in simple terms, the reward is how much money you'll get when your take profit is hit, and your risk is how much money you lose when your stop loss is hit. By saying this, I expect you to have take profits and stop losses, or at least I expect you to understand where you exit a trade if it goes good or bad. What is good risk reward for a trade? Some says that 1 to 3 risk reward is the best. And when I started trading Forex, I used only 1 to 3 risk reward ratio, and I denied all the trades without such risk reward. But then I switched to 1 to 2, and now some of my trades are 1 to 1.5, and sometimes 1 to 1. Why? Do I have bad risk reward ratio? I think no, because the second important thing is your win rate. If you're opening a trades with the risk to reward ratio of 1 to 3, you can win only 3 out of 10 trades, and you will be winning otherwise. In the end of the day or month, you will be winning if your win rate is 30% and you have a reward ratio of 3. But it's uncomfortable, you know? Market is also about our psychology. And while we are trading with our hands without any algorithms, we are subject to emotional stress, to emotional pressure and emotional damage. And to evade this, we need a higher win rate because, this Think Fast, Act Slow book or something like that. I think I named it very wrong. But in this book, I've heard about us reacting to losses twice as much as we are reacting to profits or wins. So as for me, it's just more comfortable to have more winning trades than losing trades. If your risk to reward ratio is very high, probably your win rate will suffer. It's just how the market works. If you're not like this, congratulations, but for the majority of successful traders, the higher your risk to reward ratio, the lower your win rate on average. So I decided to intentionally lower my risk to reward ratio and increase my win rate to at least like 60 or 70% of trades, or at the very minimum 50% of trades. So 1 out of 2 trades are successful, and that gives me the opportunity to be profitable over a long term. You understand me, I think. You can go for a risk to reward ratio of 1 to 3, but you need to be prepared to face 7 losses in a row. How you will react in such situation? You can ask yourself, you can simulate your reaction, but you better just try trading with a low win rate and high risk reward and see how it goes. Sometimes it's very good feeling when you have several winning trades in a row, but when you have, like, as I said, 7 losing trades, what will you do? And this is still your market strategy. This is how you act on the market. This is the part of the process. So you need to be prepared for this. To execute trades good, to execute trades like a professional, you need your mind to be as a professional mind. So here are rules for entering a trade. The general rules that I have collected to you after this webinar. First of all, it's a liquidity sweep. You need to wait for the price to collect some stop loss. Then we need a break of structure, a trend change in the direction of a bigger trend. For example, if a trend on 1 hour time frame is upwards, you wait for a liquidity sweep on 15 minutes and for a trend change also in upward direction. And then you have 2 trends looking in the same direction. Markets are fractal, trends have synchronized, you're happy, your trades goes where you want them to go. Third is retest of sell to buy or buy to sell block. I think you understand it. It's just a retest of the point of interest where some things happen with the price. It's just for our convenience we mark them on the chart. The most important is trend and liquidity. And finally, but not the least important, is appropriate risk reward. If your risk reward is great, is like it's very big, then your win rate may suffer. It's not like 100% information, but it may suffer. And if your risk reward is smaller, then usually your win rate is a little higher on average, so it may feel more comfortable to you. But at the beginning of the webinar, I said to you that I will tell you how to become more profitable, sustainably profitable, even if you do not like smart money concepts, even if you stick to fundamental analysis, Fibonacci sequences, Elliott waves, I don't know, moon cycles, anything. The main thing to become sustainably profitable and to remain sustainably profitable is to practice. Practice a lot, practice even more, and after you're done with your practice, go and practice a little bit more. This may sound silly. This may sound like I'm not an Instagram guy who sells you wealth and fortune, but I've spent hundreds of hours backtesting my strategies, opening a chart, placing all the blocks, liquidity levels, break-off structures, and just trying to open a trade like I'm in the market and look where it goes and write this in my trading journal, my diary. And I spent a lot of hours doing this. After some strategies were denied after that because I understood that this strategy sounds good, it just doesn't work. It just doesn't work with Euro USD because I love trading Euro USD. It works maybe with some other instruments, but I'm not trading them, and I do not know which instruments are working with the strategy. So I changed the strategy and I backtested it again and again and wrote it into my trading journal, and I started some challenges. And I traded with them also to understand how I act in a real case situation, because I do not only need to trade on a demo account to like backtest my strategy, I need to make forward tests, probably better with real money, to understand the emotions behind it, because as I said, the psychological factor is very important. I cannot stress this enough. But then, after you practiced and created your own trading strategy, including liquidity, breaks of structure, imbalances, BTSs, and everything, you need to follow the strategy. You need to follow it like you have no emotions, like you are a robot. You open the trade, you place your stop loss, you place your take profit, and you just wait for the trade to be executed. You do not look at the chart if you can. You do not close the trade before it goes to stop loss, even if you think it will go to stop loss. Because in the beginning of the webinar, some of you guys put a plus in the chat when I asked, leave a plus if you ever felt like the market was reading your mind, or leave a plus if you ever thought just one more trade and regretted it. All these pluses show that you know what I'm talking about. You know the psychological part of trading. You know that this may be hard. And when you open a trade, sometimes an instant like idea blows your mind and you think, oh no, this trade is so shitty. I shouldn't enter this trade. I need to close it right now. But no, you made your analysis. If the trade goes to trade profit, great. Analyze the results. Try to stick with them. If the trade goes in the opposite direction and hit your stop loss, all right. This is the part of the trading process. You do not need to change your strategy when you have several stop losses in a row. You need to maybe lower your risk, to look closer at what you are doing, maybe find your mistakes, but not changing the strategy without testing another strategy, not hopping from one strategy to another, sticking to what have worked to you with you in the past. And never violate your risk management. I mean, never increase your risks too much. Maybe your risks are not 1% on a trade. Maybe it's 2, 3, or 5% on a trade. This is your risk management, your risk approach. I'm comfortable with that. And you should be comfortable with that. But do not violate your risk in one trade only because you think that this trade should go to take profit. It just must go to take profit. There is no way it goes to stop loss. You know what happens after these thoughts and after opening a trade with increased risk? The trade goes to stop loss. So never violate your risk management. And before I sum up this webinar, just one more glimpse at this extremely rare and exclusive offer from Instant Funding. Once again, make a screenshot, return to it after the webinar, use it. It's Web25 to save 25% and increase your profit split. If you backtest what I've given to you, the increased profit split would come in handy. You understand it. So feel free to use this code. To sum up, let me show you the slide with what have you learned text. Now you learn the essentials of smart money. Now you know how the price moves. Now you know where it will move next. At least you can be sure that you have analyzed the price correctly and you'll have some ideas about where will it move next. Not 100%. Forget about this number. You have some ideas and some logically supported ideas. Also, now you know why liquidity is probably the most important topic in not only smart money concept, but in trading in general. And finally, you can now tune your trading strategy. Maybe before that, you were trading only with a risk-reward 1 to 2. Try different risk-to-reward ratio. How it goes? What do you feel? Try having a trading journal. Try writing every trade you have. How does that go? What do you feel? How your results have improved or they didn't improve? So tune your strategy, adapt it, do not hop from one to another. Like, try to remember more about your trading. Try to be honest with yourself in trading, and this will definitely help you. I promise it will help you. It helped me, not instantly, but it helped me. And that's, I think, it for the main part of the webinar. Let's chat. I will check the chat. What have you learned? Did you enjoy it? Did you liked what you have seen? How do you feel after the webinar? Maybe you feel motivated, maybe you feel overwhelmed. Tell me. I want to know your emotions after the webinar. I want to know what are your thoughts after the webinar, because otherwise I would just telling you some things without any impact on your lives, and I want to have an impact on your trading at least. All right, I'll check the chat. Let me probably open the previous slide just to have some text on the screen. All right. Will there be more webinar? I'm sure there will be. I'm sure stay tuned, subscribe to Instant Funding YouTube account and newsletter. They have amazing news sent to you by email. I always read them, so why shouldn't you? How to take entry using smaller time frame? Simple, just open a smaller time frame, analyze the liquidity, breakoff structures, points of interest, and place your trade. If you are trading on a small time frame like 5 minutes, you can use 1 minute time frame to confirm your ideas, but I wouldn't advise you to do that because 1 minute time frame are too chaotic. But still, if you have like a balls of steel, if you're really emotionally stable, trade on 1 minute time frame. Why not? I know traders who make a lot of money by trading on 1 minute time frame using what I've told you. It's not me though. I use 1 hour and 15 minutes time frame, and that's what I've shown to you in this webinar. All right, I see your ideas on risk to reward ratio. 1 to 2 is the best. I see at least several comments like this. I support you guys and I understand you. It's really a great risk to reward ratio. Maybe it's a golden average of risk settings. It's just sometimes some traders can feel uncomfortable and want to move to a little lower risk to reward. That's completely fine. Do not blame yourself for that. Just backtest what you're doing before actually doing this. All right. Oh, that's actually an amazing question. That's one is very good. So your executed trade, excellent, according to your setup. But once the price starts moving towards the target, it suddenly the chart makes the opposite structure on a lower time frame. Should you exit this trade? There are 2 answers for that. Okay, 1 main answer, you should backtest it, and 2 more detailed answer. The first one is no, you shouldn't close your trade. You are already in the trade, close the chart, do not look at it. You have analyzed the chart, you have seen that the chart is moving upwards, you placed your buy trade, you do not do anything until the price touches your take profit or stop loss. This is one approach. This is an approach that I practice. But there is, of course, another way. You can close half of your trade or close the trade completely when you see an opposite signal. Probably, maybe you're a scalper and you look at the charts all the time, you do not close them, and you see a reverse structure. Close half of your trade, or maybe move your stop loss to break even. Why not? You save yourself from losses, but understand that the price can fluctuate, touch your break even and touch your stop loss that you put in break even. You didn't lose any money, but the trade went maybe again to take profit, so you didn't earn anything. Maybe it will be uncomfortable for you. So backtest it and you'll find the approach that you love the most, but I don't touch my trades after I open them. All right, I see your comments. I see a lot of positive comments, and that's really motivating and encouraging me, guys. Thank you for all these comments. It was amazing. It was really amazing to be among you guys. I hope that we'll meet in the future again. I hope that you have learned a lot today. Maybe a little bit too much of an information, but I hope you made some screenshots. You will look at the webinar after it ends. You will maybe rewatch it later. And don't forget to backtest. Don't forget to improve your trading. Don't forget to educate yourself. And it was me, the Edward, your mentor for today's webinar. Thank you again. Have an amazing time. Happy trading. And I'll see you in the future. Goodbye.